I'm not trying to tell people that they need a financial planner. I think there is research that says, hey, you might benefit from a financial planner. You might benefit from better investment advice. You might, but then again, there's a lot of shoddy financial planning. There's a lot of shoddy investment advisors out there. So, it may be a crapshoot. You got to pick the one.
Tell me all about your property and I will pair it. I'm looking forward to making another one of those videos. Jonathan, how are you, man?
I'm doing really. That is the most unique beginning that I have ever seen. I think you found your tribe, man. That's really cool.
I found my what?
Your tribe. You do what you love to do, and people are attracted to the thing you love to do because they like to do the same thing. It's that you found your tribe. It's great.
Yeah, that's right. Well, I was actually talking with my son and a friend one day, and we were talking about various cigars, and Ben, my friend, said, man, you ought to figure out a way to work cigars into your show. I thought, oh, that's where it came from. And, just something to add a little humor or whatever. All right, everybody, this is Jonathan DeYoe, and we are going to talk about the happiness dividend now, and we're going to try to answer the question whether or not financial prosperity and peace can coexist. And so I think that it's good, Jonathan, if we could just begin with a definition of some terms. What do you mean when you say prosperity? What do you mean? What's your definition of it?
It's a good question. Just really quick. I love the fact that you've named it this show, the Happiness Dividend Show. You probably don't know the history, but my blog used to be called, before I published the book, before I rebranded my company, the blog was the Happiness Dividend Blog. And so I'm just excited that you're using that particular term out of the title. It's really cool to see that there again. So prosperity, I think it's really simple. Actually, it's personal flourishing. It's personal thriving. It's about happiness. It's about well-being. In my book, the entire middle section is about how philosophers and psychologists and religious folks have defined prosperity for thousands of years. And it includes things like family relationships, friendships, health, opportunities for learning and experience, meaningful work, self-accountability, generosity, optimism, gratitude. These are the things that are the signals of a prosperous life. Now, it often involves wealth, but it doesn't require it. Prosperity requires enough. It doesn't require wealth.
Interesting. All right. And does enough have a fixed definition?
No, it's every single person's enough.
Yeah. I can't remember which millionaire. I heard this many years ago, and I obviously wasn't prepared. I don't have any notes in front of me, but it may have been J.P. Morgan, but I wouldn't go to the mat on that. They said, how much money do you really need? And he said, just a little bit more.
Right.
And so, but that almost belies the fact that, he didn't feel like he had enough. And so that creates some tension in there. All right. So on the other side of this prosperity, just give us a working definition of peace.
When we talked about this idea of peace for me is actually harder to define than prosperity. Yeah. So for me, it's like a quiet calm about your life. It's reflective, it's easy, it's knowing that the enough exists for you to do those things that you have written down that you want to do. It's partially defined in the lack of stress and anxiety, but it's also just that knowing, that calm knowing that it's going to be okay. I think that's where, for me, I would define peace.
Yeah. It's sort of like an attitude. It's all good. It's all right.
Yeah, exactly.
And I've told my wife this many times, and she's not on this call, but I'm sure she will hear about it because people that know her are on the call. But one of the things that she brought into my life, and I already had a pretty good measure of this, but I tell her one of the things I love about her is she just has a factor about her. When she's around, I just feel, it's all good. And
yep.
Yeah, it's hard to put into words, but that really is what peace is. and it's all good. And I think the peace is what enables you to avoid road rage by, just maintaining a kind of perspective about, that nobody was hurt. That didn't matter. And obviously that person has somewhere they need to be more importantly than whatever I think I need to do. And so, you know, it's sort of a
Good
perspective
luck with
thing.
that. Good luck with that. I can be very peaceful and then still experience road rage. Like, there's an awareness about it's going to be okay, and that dissipates in times.
Well, this is where I have a chance to maybe claim a little moral superiority, because I really don't care, man. I'm not an aggressive driver. I really don't care. But that is what I tell myself when people cut me off. I say, obviously, you need to be somewhere more importantly than I need to be somewhere. And so you go right ahead because your schedule is more important than mine. And the other thing I tell myself, and this also allows me to laugh a little bit, I say, well, you see, unlike you, I planned ahead, so I'm not driving like a maniac to get where I need to be. I knew Atlanta traffic was like this, so I left early. And those things actually help.
Yeah, for sure.
All right, so now we talked a little bit about prosperity and a little bit about peace. How do you connect those with the happiness dividend?
So I'm probably gonna go a different way with this.
Okay.
I don't think everyone needs a financial planner. Like, I think there are people that don't need a financial planner, and those people are generally, they're fine with the volatility. They know how to do the math and line things up. They know how to plan for their own futures, and that's fine. I mean, I work with people that want a financial planner. I'm not in the convincing business. I'm not trying to tell people that they need a financial planner. I think there is research that says, hey, you might benefit from a financial planner. You might benefit from better investment advice. You might, but then again, there's a lot of shoddy financial planning. There's a lot of shoddy investment advisors out there. So, it may be a crapshoot. You got to pick the one. You got to pick somebody that's going to actually really take care and really think about you and what's good for your family. And that's
Okay.
that's really, really important. Finding the right one. But some people can do it without one. I think that's reasonable.
Well, when you said not everybody needs a financial planner, I started laughing because I thought, yeah, like 9 out of 10 people that talk to me on my way, I walk to work here in the city of Atlanta every day. And most of those people that talk to me, they don't need a financial planner.
Some people need one. They don't realize it.
They need any loose change I can spare to help them get some water, which they could go get for free almost anywhere. But that's a whole different subject. So so let me try the question again. What is a life situation in terms of wealth or risk tolerance or something that would prompt a person to come find a financial planner like you?
I think that the number one question that people have when they come in, and we started kind of talking about this early on, is, will I have enough? How do I know if I'm going to have enough? How can I be confident that I'll have enough? And that question of what's enough for them, they want help figuring out that enough, and figuring out how to ensure that they have enough, and how to ensure that when they leave the planet, they leave something behind. And so somebody that is asking the question of, how do I make sure I have enough? I'm 5 years away from retirement. How do I make sure I have an income stream that I won't outlive? How do I make sure that income stream grows, rises with my rising cost of living? How do I make sure that I leave something behind for my kids and my community? And that's 90% of what we do.
Yeah. How hard is it when somebody says, will I have enough, when you have to say no?
It's really hard. Yep. I have someone I'm working with that we've been going back and forth, back and forth, back and forth. And I'm telling him that he has a lot, but he spends a lot. And so I keep trying to say, you can't spend 12% of your asset base on an annual basis. You can't. You will run out in 10 years. Like, it'll be gone. So you have to have a much larger asset base, or you have to spend less. It's a trade-off. And I don't care which way you go, but you got to do it. And it's very difficult. And we're arguing about it. I'm like, it's just math. Like, I'm not telling you anything that's not easily defensible here. It makes sense, but they don't want to hear that.
So if you're thinking about an asset base, and you've got this pile of money, let's just say, and it's getting a return, what is a typical return your clients are seeing, or you like them to see, like an ROI
Wow.
on the whole thing?
Yeah. So I mean, that it depends completely on the individual and the kind of risk that they take, right? There isn't an optimal portfolio. There isn't an optimal return. Obviously, we want to have more return, but we also want to take less risk. And so that's the trade-off that every individual makes for themselves.
Yeah.
There's a lot of research in the industry, in my industry, about not so much the return, but the safe amount you can withdraw. Right. So there's a thing called a safe withdrawal rate that's been studied, lots and lots and lots and lots. And that safe withdrawal rate is about 4%, 3.5% if you want to be more conservative, 4.5%, 5% if you want to be a little bit more aggressive. But that safe withdrawal rate is 4%. What that means is you draw out 4 on an annual basis.
Mm-hmm.
The portfolio goes up more so that next year you can draw out 4 and it'll be a little bit bigger. So your income rises with your rising cost of living. It's interesting to talk about that with, on Flipping America, because I look at real estate as above the line. In other words, that's income stream you're getting that isn't gap income you're trying to fill with portfolio, right? So if you have enough income from real estate, then you don't have a gap. You don't have a amount you have to fill. And so there's people that have oodles of real estate. We have clients that have lots and lots of real estate, and they've got plenty of income coming from real estate that, they don't have to have a portfolio. They've got income coming from other things. Now you'll know that you got to have liquidity if you have real estate, because chimneys fall, stuff breaks, you need to put in it. So you got to have liquidity, but you may not have to have a portfolio. The portfolio comes when you're trying to fill the gap income from your fixed income and your expenses.
Now, when you say portfolio, you're referring to a stock portfolio, I guess.
Stocks, bonds, blends, commodity, anything that's sort of publicly traded, you can cash,
Okay.
Yeah.
Okay. Fairly liquid and publicly traded.
Yeah. Exactly.
That's good.
Yeah.
Okay. So if now you're talking about the safe withdrawal rate, do you do any work with actuarial tables to see how long this person might be expected to survive, to know is that connected to the safe withdrawal rate at all?
Absolutely. The safe withdrawal rate comes from the couple numbers you can tie to the safe withdrawal rate it's based on a 60% equities, 40% fixed income portfolio, and it's based on 30 years of withdrawal. And that is a safe estimate. 4% is a safe estimate based on those two things. There's additional research that says if you lean towards smaller companies, maybe you can make it 4.5% become safe. I'm just saying there's a ton of research. 4 is a good starting point. 60, 40, 30 years.
Or if you have a bunch of bad habits like smoking 3 packs of cigarettes a day, you could take out more because
right.
You're not going to live as long.
Not going to live as long. Exactly.
Yeah.
So the primary title of the book is Mindful Money, and then the happiness dividend is in the subtitle. And so I think about it in terms of mindful money. And so let's
talk about mindful money. That's an interesting phrase.
Yeah. So it's, how do we bring mindfulness and money together? So it takes a little bit of history. I'll do this as quickly as I can. So many, many, many years ago, economists told the story about man, woman as a rational animal. The idea is that, we gathered information, we gathered data, we analyze and we make trade-offs and we think about it very deeply, and then we make a rational decision. But it turns out that's actually not how we make decisions. If you think about your own reactions to things or your own, big decisions that you make, it's you're subject to cognitive and emotional bias. And that's what they decided like 20 years ago. Psychologists won the Nobel Prize in economics because of this concept of loss aversion. This is a bias we hold. And now today they've chronicled hundreds of these biases. And this is what has become known as behavioral finance. But they said, you're not as rational as you think. You have all these biases, cognitive and emotional, but they didn't give us a path to how do we get around those biases. They just said, hey, you're subject to them. Good luck. Right? So mindfulness is, it's become very, very, very secular. It's become something that every religion practices. It's become something that that many people talk about. That if you go to, there's YouTube videos after YouTube videos about mindfulness. There's coaches about mindfulness. There's entire corporate leadership groups that talk about mindfulness. I mean, mindfulness is a pretty well accepted concept, but what it is in general is this creation of this pause between a stimulus that you receive from the outside world, that person cutting you off in traffic, and your response, and your ability to say, maybe I don't need to yell at this person, because maybe, as Roger has told us, they have somewhere to be that's more important than where we have to be. And just recognizing that. And whether that's you bringing the mindfulness and the money together, it's maybe I don't need the boat. Maybe I should take this money and use a down payment on a piece of real estate. Maybe I should take this money and invest in a stock or a ETF. Maybe I should take this money and do something else with it. And then when the real estate, you get in there and you peel away one of the walls and you find dry rot, it's just what's there. You still have to just act and rebuild and fix it and go past it. And then, maybe you won't make as much profit on that deal, right? But that's okay. There's another deal, right? Don't overreact. Don't get too upset by it. Don't get emotional by it. But have that mindfulness that says, okay, this is what is. We don't need to overreact. And that usually makes life a lot more prosperous and a lot more peaceful.
I like that. And really it's, I've wondered a little bit about, mindful being a buzzword and all of that, like you talked about. But what you're really saying is just a matter of taking time to gain a perspective and look at it in some sort of a context that's going to allow you to remain calm.
We talk about mindfulness as a doorway.
What would you
there's a phrase that we use all the time, and it's very simple. Stop predicting, start planning, stay mindful.
Love it.